right. We'll let a few people kind of roll in here first, and then we'll get started.
My play like a champion banner there, by the way. Is it backwards? Is it like, does it read backwards?
No, it looks good, man.
Oh, I can just see it backwards on my screen.
No, it's mirrored correctly. You're all good.
It's signed by Rudy.
Oh, I like that.
I know.
It's
Rudy
even better.
Rudigers. I know. Rudy signed it.
Awesome. All right, cool. Well, I think we've kind of reached a little bit of, I think we got more people rolling in, but might as well go ahead and get started so we can leave some time for some Q&A at the end. And we want to get into the heart, the guts, and the meat of what we're talking about today. So welcome everybody to the webinar. This is a webinar about the aggregator landscape changing for good. So, you know, we got a great panel today. We got full of operational experts that have a lot of years of experience. In recent times, in recent history, we've read a lot of news and market hearsay from colleagues that the current operating environment for digital first businesses has been a little bit arduous. However, today we're going to be addressing topics of positivity. Our goal is to let you hear directly from some of the larger operators, aggregators, about their firsthand experience and where the market's going to go in the next 12 to 18 months. So let's introduce our panelists. And panelists, if you wouldn't mind just giving a quick overview of your company, your fund, and any pertinent details you wish to share. I'll introduce myself first. My name is Chris Schipferling, the guy who's speaking. I'm a co-founder of a lower middle market investment bank called Global Wired Advisors that was started 4 years ago. Our thesis was very simple, to provide an institutional level process to the lower middle market, small business, and digital first companies, e-commerce based businesses. So would love to now go around and allow you guys to introduce yourself. We'll start with Walter Gonzalez from Goja, the president, founder, and CEO, if you don't mind introducing yourself.
You did a good job there. President and founder of Goja, started Goja 13 and a half years ago. I was just telling you guys how I remember when somebody said Amazon will never be bigger than eBay, and so 13 years later, seeing kind of what this has turned into is pretty amazing. So we've been very much an operator from day one. We started getting lumped into the aggregator space, but we've always just been really deep operators. Love making products and selling products that people want. So that's kind of the sum up of our story.
That's awesome. Well, great. Rowan Lawson has joined us. He's the head of M&A for Heroes. If you want introducing yourself.
Hi there, Chris. Thanks a lot. I come from Heroes. Like, we're a UK or even a London-based consumer brands business. We started up 2 years ago. We've heavily invested in a platform, technology, and a team to operate and grow our kind of family of brands, as we call it, to become kind of true household names of the future. We have a very kind of developed and refined thesis around some of the key categories we really like, and are always looking for more kind of brands to join our family. And I guess the final piece is, like, we thoroughly enjoy building partnerships and going out there and building partnerships and learning more about the e-commerce space. Always happy to grab a beer and exchange stories.
Awesome, great. Next up is Santi Nesteres, co-founder of Benitago.
Yeah, so we have a bit of a different story. We started about 6-7 years ago, pre-Thrasio, pre-big aggregator days. We created the first 5 brands from scratch. They're all still are eight-figure dollar brands, all from our college dorms up in New Hampshire. We focus half on acquiring other assets and half on developing our own products. We've developed over 200 SKUs that contribute significantly to our EBITDA. And yeah, we don't spend money on conferences. We're like sort of heads down operators since the very beginning. We've acquired over 20 brands to date, and yeah, it's a good summary.
Awesome. Thank you so much. Next up is Eric Davidic from Sellers Funding.
Hi, everybody. So Sellers Funding, as you may or may not know, offers kind of a tech-based platform for operators, aggregators to find working capital solutions. We have, cross-border payment, all kinds of different options for people to get access to capital. Specifically, I work formerly at Heyday and have joined the team to essentially build partnerships with aggregators to offer them these services at a portfolio level.
Great. Awesome. Thank you guys so much. I think we're going to have a very spirited discussion today. Obviously, there's a lot going on. There's a lot of, as I mentioned in the introduction, there's a lot of hearsay. There's a lot of market news, a lot of opinion, water cooler opinion. And so I think today we'd like to really have a good spirited discussion around, hey, where is everything going? What's going on right now? Let's hear from you guys. And at the end of this, of course, let's hear from everybody on this webinar, any questions that they may have. So let's start with our first question for our discussion. So in all asset classes right now, we've seen a lot of change in correction. Specifically, e-commerce has seen a correction in sales velocity. So we're moving into a more normalized operational environment. So first question really on the docket is, why are these current market changes a good thing for e-commerce sellers? Let's start there. So why don't we start first with Goja? We'll go in the same order, Goja, Heroes, then Benitago. So Walter, if you don't mind taking the stab at this first question.
It's an interesting question. It's good because it's putting the emphasis back where it needed to be, which is if you're a really good operator, you're going to be okay. If you're not a good operator, it's a tough environment. And so what we were saying a few minutes ago, Amazon has, after doing this for 13 years, the instability, the up and downs become the norm. And so if, for us, we were very lucky to build pretty deep merchandising operating teams. And so the instability is something that is rooted in us, and so that makes it stable. And so over the last 3 years, it felt like we got away from the stability that was embedded in Amazon, in SKUs always being in stock, all of those things. And so I feel like we're going into a great place. We kind of got past the supply chain, not all of it, but some COVID and all of this money that came in so quickly. And so we're actually going into the place that we lived through for 9 years. Then we went into this crazy place, and now we're going back to normal. So to me, I'm very excited for the place we're going to, even though of course it's difficult for a lot of places and a lot of people. So I'm very sensitive to that. But in general, I think I miss this place. You know what I mean?
Yeah, no, I hear you. Rowan, what do you think? What are your thoughts?
Yeah, I mean, to be honest, when we've been in the market for a good couple of years now, for us, it's always been about kind of quality over quantity, I would say. And although it's corny, it really is true to say that the cream does rise to the top. Aggregators now probably more than ever have tools and experience to look deeper into brands and further into them, and especially to take a bit of an appraisal there. So despite some of the corrections in the market, I think top sellers and top brands are still seeing some insane progress and performance. Yeah. And so I think there's a really fantastic opportunity out for them.
Yeah, great. Santi, what are your thoughts?
I like computer science is at heart. So I think about it. There's a concept called regression to the mean that I really like. It's a bit echoing what Walter said. There was, but back in the war days, there was like, I think a Japanese general was training maneuvers on the planes, and every time they would fail the maneuver, they would slap him in the hand. And every time they would do a good maneuver, they would praise them. And then every time they would praise them, the next maneuver was actually a worse maneuver. Every time they would slap them, the next maneuver was better than that one. And they thought that it was the praises and the slappings of the hands that made it so that they would do better or worse. So they would stop praising. And in the end, it was just regression to the mean. Whenever you do a sub-average maneuver, then the next one with a likelihood to be better was there. So I think what we're living is that. I'd say, like, if you backtrack to 2-3 years ago, we would look at this space, and this is a great space. The cash flows are there. These are great brands. They're assets that sustain over time, but nobody was paying attention. I think we were below the mean, and then suddenly came all this funding. Anyone who would raise the hand would get $100 million. It became about who would do the flashiest conference, who would publish the biggest round. And people forgot about the fundamentals, about what it is to run a brand. And the first headwinds came over, and now we're going down below the mean. So I think we've always tried to stay focused on what does that mean? Operate the brands well, buy well, select your assets, and pay high for the assets that you really, really think are sustainable. And the rest is just noise.
Yeah. No, I'd agree. I mean, I think the running joke is always everyone wins in a bull market, right? So, we felt tons and tons of tailwinds, through the pandemic. And I think what happened is sellers who never in a million years thought they would be as big as they were. I mean, we saw it. We saw sellers that we even took to market in 2019. They were, a smaller business. And then all of a sudden in 2020, they were they were forced to actually be a large company with real infrastructure, and they were struggling to even do that. So I think to echo what you just said, I think the current environment absolutely is forcing sellers just to become better operators in general. And now moving forward, they've got to really start thinking about themselves as a real CPG company, not just a commoditized marketplace, product, profit, price, et cetera. But, if I'm going to become a valuable asset, what am I doing to really drive value inside of the business from those traditional I call it the traditional tenets of a CPG business. So, well, where would you say we are in the current change cycle, and where do we go from here? Walter, I'll start with you.
And I'm looking at this, if you look at something over 100 years, this is not that big of a change, right? It's going back to the normal. And that's why, but even 13 years, okay, Amazon's not been around that long. It's been about 13, 14 years since they allowed third-party sellers to sell on their platform. So again, over a longer period of time, it doesn't feel like that much change. It feels like we're going back to where we were always supposed to be, which is, X amount of months of supply chain, not overpaying crazy, PPC where it should be. Like, so from a change cycle, I think we're going back, like I said a few minutes ago, back to where I love, which is an operator focused, customer focused, product focused environment, and everything else is just noise. It was just stuff that didn't add particular value to the brands, to the sellers, to the customers, all of that. So from a change cycle, I really like where we're going. I really do, even though I feel the pain of the world, but from a change, it's from a business, and when I think about what we are doing more, or what we're doing less, we're doing a lot more of the things that we knew to do when we started Magic Fiber, as a brand 13 years ago. We were like, well, what does the customer want? And why do they want this color, not that color? Like, a lot of the conversations are around that. The only thing that's changed for us is, when we think about doing anything, we think about doing it at scale. And so one thing is to manage a campaign of PPC. You could do that 30 years ago very, very manually. Today, we're thinking about what 40,000, PPC campaigns look like, and tens of thousands of words. And so the conversation, we're still doing the same things, but we're having to think a lot about how do you do this when you're 2 times bigger, 3 times bigger, 4 times bigger. And so the change is not because of the market, the change is because of, who we have become. And so those best practices we had, how do you not lose the magic sauce or the magic whatever when you were little, and when you were doing it 13 years ago for one SKU, how do you do it at scale, And so the change is coming because of the size, less than because of what I think is happening in the market. That the market I find still to be quite stable. You know what I mean?
It is.
In the things you've got to do to succeed.
Yeah, I would agree. And I mean, like any market over the course of history, I mean, there's evolution and adaptation, right? The market just continues to get better. This is a really good thing. We had a lot of cash pour in, and we are now trying to figure out what to do with all that cash and how to put it to work. And now we're trying to figure out, how does this thing become mature, and what does maturity look like for this particular market in this sector? And a lot more institutional hands are starting to get involved, and that's a really good thing for this space. Very good thing.
Yeah.
So
Yeah.
What are your thoughts, Rowan?
Yeah, no, like from my side, I think we take a step back and look at the whole market in general, like the whole e-commerce market. Look, there's been an adjustment, no doubt. Like you've probably seen that, there are charts on e-commerce penetration going crazy during COVID in 2021, and then that's like dropped back down, right? But as Santiago pointed out, it's back in line with the moving average, which actually over time was trending up and in the right direction, I think, for everyone involved here, right? So that I think the picture has shifted, but it's back in line with expectations. I think, from our point of view, looking at some of the brands we've owned and generally brands out there, people's perceptions and the customers' perceptions has changed as well. So it's a combination of like, how do you position and market products in the same way? Is it the same way, or do you need to think about things differently? Different channels, you have different approaches, etc. So it's like, how do you react to ever-changing customer approach and customer perception in this whole market? And then the final one is all about supply chain. I think, look, that's crucial. We've seen it, we've talked about it going nuts, insane delays and prices going through the roof. How do you actually adjust for that? And how do you set up systems and teams in place to get stuff in the hands of customers, when they want it? And sadly, with things like Amazon, etc., they want it the next day, right? So to get stuff all over the world is a real challenge, but having systems and platforms in place, that is really important.
No, that's a great answer. So Santi, what are you thinking, man? What's your thoughts? You're on mute.
Just realized I was muted. New York is noisy. So I think like, look, I still think there's more to go down in terms of where we are and what that mean is. We joke internally that there's still a lot of well-capitalized idiots out there. Like there's still a lot to weave through. The capital, so much capital hides competency from incompetency, and it kind of mixes it all together. And there still needs to be some more headwind to blow the leaves away to see what are the leaves that are alive. But over the long run, that's a good thing. That gives more stability to the sellers. They know what to expect on the line. There's not going to be people playing funky games with LOIs, and the market's going to get to that new stable normal. Volatility is not good for anyone. You know, there's home runs that you can hit, but then over the long run, it's not good. So I think where we go from here is there's going to be still some more headwinds. The good operators are going to become stronger. Good companies become great companies. Others will have to eventually just consolidate. And for the seller, it's just good news. The sellers, nothing's happened to the seller. If you ask a seller, they're like, yeah, business as usual. Nothing's happened. This is the first time people who came in and lived a surreal year in the space have now been faced with what the sellers have been faced for the past 6-7 years. What we've been doing and operating for the past 6-7 years. So it's a healthy but painful transition. And obviously we have empathy for the pain, but over the long run, it'll be good and healthy for the space.
Yeah, you know, I was good feedback. I was talking to a friend of mine who sells into the beauty, the health and beauty space inside of Target, and she said that you know, Target's been doing a lot of investment inside of direct to consumer brands inside of their stores, right? To drive lots of traffic, because, you know, we all know the running joke is you walk into Target, you're not walking out unless you're spending over $100, period. But what's interesting is she said that they have moved into a new strategy for their merchandising in stores, and they're calling it Simplify and Amplify. And it sounds a little bit like what you just said. Just simplify, amplify is really kind of where they're headed. And it sounds like that's where a lot of these operators, good operators now, as you just said, kind of looking at what's left and what's really happening here, and how do we move forward. So Eric, what are your thoughts, man? Bring us some pain, buddy.
Great. Glad I get to be the one to bring the pain. You know, it's interesting because I think that one thing that all the money that's flooding in has done, I mean, as Santiago suggested, sometimes maybe it's not always the smartest money that's come in, depending on where it's been funneled, but you know, it's allowed for this market that has been kind of slowly building in the background. You know, aggregators existed prior to 2 years ago, as all our panelists can attest to. But, you know, this influx of capital has allowed a real fast learning curve. And I think the benefit for sellers on that end is that, you know, there's a lot of technology, a lot of insights, a lot of best practices that are going to be developed with this money coming in, that are going to naturally trickle down to individual sellers. So, you know, I think ultimately, as everybody's kind of suggested, this market has, you know, kind of maybe peaked and is settling in a bit. There's going to be some pain around that, and there will be winners and losers. But, you know, ultimately, all of this information, this influx of capital, this attention is going to trickle down to these individual sellers, which, you know, if you've held on to your brand and you feel like you've missed this, you know, huge bump or this huge opportunity, it's only going to continue to be there. It's just going to be a little less dramatic.
Yeah, good feedback for sure. Well, you know, kind of piggybacking a little bit on what you said, Santi, you know, it's almost in some sense, nature is healing. You know, obviously with the recent earnings reports that we saw from Amazon, we're headed back to what would be considered pre-pandemic levels. But if you actually look at the chart, it's not as low. You still had a lift. You had a lot of new users come online and get you know, adapted to utilizing the Amazon platform, et cetera. So, you know, there's still a lot of, I think, Walter, as you said, there's still a lot of good here. There's still a lot of positivity in terms of, and Santi, you said it as well, you know, as far as from the seller's viewpoint, you know, it's not like, you know, they just went through some tornado, right? But as far as just as you're looking into the future, right? So you're looking into 2022, 2023, you know, as you consider all of these things, has there been any shift in the way that you view your M&A strategy moving forward? And Walter, we'll start with you.
There are some things that have changed. I do think that if you started a brand, I don't know, whatever, 13 years ago, you had a better chance of starting a successful brand than you did if you started it a year ago or 6 months ago. So I do think some things have changed. And I'm going to your question, but there's a couple of things that have changed. The other thing that I find that is interesting is when we were really big in the photography space, and we were growing by leaps and bounds and really selling tens of millions of dollars of just photography stuff, even though photography has been consistently declining by like 10 or 20% every year, year over year. And you would say, well, how is it that you're growing in a declining space? And it was because I think really good operating on Amazon trumps a lot of sellers, right? So you could have 1,000 sellers or 100 sellers, but the one that can position themselves the best, that can operate the business the best, always had the biggest chunk at the top, and then all the lesser performers were playing down here. So if the market was shrinking for them, well, it was killing the bottom 10%. But there was always space to grow. I say that in the context of, like from an M&A strategy, I think there's still a ton to go. It's still a huge market. There's still a ton of great brands, ton of great SKUs. There's a ton of growth, even in a declining space. And so from an M&A perspective, we've never been the most aggressive in the pack. We just bought what we thought we could operate well. We've always bought in our categories. And so we'll always continue to, but it's never been driven by, I don't know, investor pressure or do we have a lot of cash to deploy? It's been driven by what is the bandwidth? Like, can we manage this properly? And when we can chew more, we bite more. When we can chew less, we bite less. But it's always been within the discipline of operating. And so whether the market is correcting, not correcting, growing, not growing, there's always a really interesting things to buy if you can operate them well. And so it doesn't change it doesn't change our acquisition strategy, because our acquisition strategy is so much geared by our operating capabilities and bandwidth,
It's great.
So it hasn't changed. Maybe that was a long-winded answer to say.
No.
We haven't changed too much, but we haven't changed over a long time,
Context is important, man. Can't just give a binary quick answer. I mean, that was very good context.
Yeah.
Rowan, what are your thoughts?
Yeah, I think when we've looked at businesses, we've always gone, looked at pre-pandemic sales. We've gone 2019, 2018, or even before then, right, to see what the overall trends look like without COVID, without, supply chain issues, etc. In reality, that's now a long time ago, and there's a kind of new norm, but we're now seeing brands that are doing exceptionally well after COVID. And I think the common theme throughout this call is, top sellers really do rise to the top. And so I think that there are sellers who have identified, have sourced and marketed a product that chime well with customers and managed to find and achieve true kind of brand recognition and brand equity. I think these are the gems that we're all kind of looking out for. Like, if we're all looking to develop consumer goods and consumer brands businesses of the future, your P&Gs, your Unilevers, etc. And for that, you need to have brands that are really standing on their own feet in their own markets, is one point. And I think the second point really is like, look, we're starting to look at more kind of strategic deals. Maybe brands might have a specific team, they might have a specific bit of technology, some proprietary technology or some infrastructure there that might be beneficial to us as well. So there are some different kinds of acquisitions, I guess, going forward as well.
Interesting. Santi, thank you for that answer. Very good, very, very good. Santi, what do you think?
Answer is no, nothing's changed. I think like same thing, same playbook, same bar we're setting. I think both with hiring and with acquiring, we always set the bar, and then if nothing clears it, nothing clears it. And if 20 clear it, we take the 20 as long as we can intake them. So I think the only thing that's changed for us is there's more deals that are clearing the bar. We're seeing more deal flow. I think sellers are realizing that the dumb money is drying out, and we're getting to see more going through our table, and we're bidding on more. I think we're signing final documents to close a deal today. We signed an LOI earlier this week. We signed one the week before, and these are meaningful, almost 8-figure revenue LOIs and assets we're closing. So we're still growing month over month. We're still, when I think there's a Warren Buffett quote: "When others are fearful, you got to be greedy," and the other way around. For us, it's just we set the bar, and more things clear the bar. We've always been of the thought of select the asset well and then pay as much as you need to get it, rather than just setting the cheapness, because otherwise you get negative bias selection. So we've continued to do that. and we hope that over time, it'll be a balanced market where the operational excellence of the buyer is going to matter more to the seller, given that there's usually earn-out components, and we the better operators in this room will hopefully come ahead.
Like it. Eric, from your seat, you speak to everybody on this panel, and then you also speak to other operators that are in this space. So, from your perspective, are you seeing any kind of shifting winds? I mean, we obviously know that some of the larger, I wouldn't even call them necessarily larger, but more of the household names per se, the ones that get all the news, maybe a better way to say it, have obviously changed their M&A strategy, one of which just said we're done for 18 months. But from your seat, are you seeing any shifts from something that mirrors more or less the funds that we have on this panel today, really strong operators?
Yeah, there've been a couple of interesting things I've noticed since coming over, from Heyday to Sellers Funding. Now I'm having conversations, as you suggested, with a lot of different aggregators, and it's been an interesting window into the kind of investment theses, the operational theses. What I'm seeing is this probably isn't a surprise to anybody, but those whom I'm speaking with that have been focused on the operations, that have been very careful about how they've made their purchases, who have really followed instead of like following the opportunity, the shiny object in front of them, those that have kind of followed that investment thesis and stuck with it through these what have been really good opportunities for aggregators, seem to be the ones who are also coming through this with more direction and clarity, and in a much better financial position. The other thing I'm noticing is that there's a lot more collaboration. I think this is a pretty good example right here. I don't know that a year or so ago that all these aggregators would be willing to come on and kind of talk about what they're doing and how things are going. So I think that's pretty good as well. The other thing I have to mention, coming at this from the operating capital side now, I think that a lot of the aggregators I speak with that are looking at ways to, free up cash, whether it's through services like Sellers Funding offers or others, those that have operating capital available and kind of use that as a tool, tend to also be the ones that are following this and the same investment thesis and are setting themselves up pretty well here for the future. So
that's great. Good perspective. Well, let's shift a little bit to some internal, external factors. What are, in your opinions, external and internal factors affecting this market shift? For instance, we have macroeconomic headwinds like inflation, and people have been debating, is it transitory? And most people at this point would say, no, it's not. And where is it going? And what's going to happen? We've got the war, of course, in Ukraine that's affecting a lot of different types of commerce. So we've got supply chain bottlenecks. Now, Walter, you alluded to, and I agree with you, that it seems to be starting to dilute a bit. We're starting to open up, and especially with China's policy on the zero COVID, but they've been opening up the ports and trying to get those back open ASAP. But would you mind talking through quickly some of the points that you guys believe are some of the internal, external factors that are affecting some of the market shift that we're feeling right now, and how that's affecting you and how you operate? Walter, I'll start with you.
I think you nailed them. Look, from an external perspective, we're all paying the same containers for the most part. We're all kind of feeling the pain. That 5% surcharge from Amazon for fuel just sucked, right? It just did, and everybody felt it. One of the things that keeps coming to mind is when I think about the smaller sellers, like if I'm a smaller seller and I'm thinking, do I sell my brand or not? Do I want to keep fighting this battle, or do I think getting out? I have seen some shifts that just strike me. 7 years ago, or whatever it was, when Amazon, or 6 years ago, I think, when Amazon started their pay-per-click, platform, I think it was a lot easier to compete than it was today. And from an internal perspective, so from an internal factor, so again, the war, all of the externals we're all feeling. What I'm seeing, I've spoken to sellers who say, look, my budget for PPC is $50. $50 a day. And it could be that they should be spending 1,000 a day, but all they got is 50, or they should be spending $2 and all they spend is 50.
Right.
And why I bring that up is, if, like the levels of sophistication to compete in this market, which is, I guess, an internal thing, the levels of sophistication to compete in this market are growing, right? And so you might have a great product, you might be super customer focused, but if you don't have a pretty firm grasp of PPC and Amazon marketing and how it affects your life, and I think you're going to have a tougher time every time, as every day. And your solution from the past, which was I'll go to an agency, starts to get tougher and tougher. And so, I think that sophistication level. So PPC is something, or Amazon marketing, you've got to be really sophisticated around. Supply chain, like, now I'm not talking about the from China to Amazon. I'm talking about getting it into Amazon and avoiding, oversized fees, or avoiding overstock fees, or long-term storage fees. All of those things become much less about the product, and they become around being a really detailed operator. And I think which it wasn't like that before. Before, it's like you could get product into Amazon, no questions asked. You could get something positioned on Amazon, marketing, no questions asked. Today, those things are getting a little tougher. And so if you're a seller that has a great product, I think your question is, do I want to become really good at and sophisticated at these internal things that maybe before I didn't have to be that great at because I had an amazing product, and you know what I mean? So if I'm internally, I think the marketplace for the top is starting to get, or is already quite sophisticated. And I think sellers have to ask themselves, do I want to go to that level of sophistication? And if I don't, I might have an amazing product. I think this is the right time to maybe consider, doing something with my brand.
Yeah, and for the sake of time, does anybody else want to take a stab? Walter, you gave a great answer, man. That was very detailed and thorough. I like it. Santi, Eric, Rowan, do you guys have any comments or thoughts on that?
To be honest, the only thing from my side is, like, one thing I think that we've seen with the amount of press that's gone in, or the aggregators, or the funding, etc. There's a big focus on aggregators and the buy-up happening, but also there's an incredible amount of knowledge sharing and partners that have evolved in the space, right? So whether it's a seller's mastermind group, or even conversations and webinars like this, right? So there's a lot of knowledge going around, and people love to network, right? So get out there, go and join these conferences, go out there and meet people, grab a beer with someone, etc. Is one thing. And you might have an issue with your brand. Chances are someone else has had it in the past. They may be able to help you with that. And then the second one is, look, there are some incredible people out there who've developed agencies, as Walter pointed out, specializing in certain areas. So at that point, you might want to potentially outsource it if you're not necessarily in the mood to sell at this stage.
Gotcha. No, great feedback. So moving along, I heard the term funding, which leads us to our next question, which is, and this is a little bit of water cooler, a little bit of hearsay. We heard a lot about this in 2020, 2021, when a lot of the first wave of venture debt was deployed. There was a lot of pressure from your investor base to deploy that capital as fast as possible. So, the question on the table is, do you think there's current pressure and now moving forward to deploy that capital to go buy businesses? What's your thoughts currently on that? I'll let you take a stab at that first, Santi.
Yeah, and to answer your previous question, by the way, like, I think that to sellers, the micro has always mattered more than the macro. They certainly feel the macro, but to a seller, it's way more damaging, or when the listing goes down, or where their storage limits just magically go down and they can't inbound more inventory, or when there's a big seller that somehow is selling at a huge loss at half the price and just dumping inventory. So those things matter way more to a seller than the macro. They almost probably laugh. Sure, they also have to pay the container prices. I think those things do affect, but they almost laugh at when the aggregators point fingers at things, and it's like, look, the tide did retreat a little bit, but the micro has always mattered more than the macro. And I think what Walter said is it's also becoming more true every day, which is this: as consolidation happens and sophistication level goes up, and it's not just about having a great product that has a great moat around it, but is becoming a very good and sophisticated operator. And that's where scale helps, and why there is a fundamental model for aggregators and for big houses of brands. To the segue to the question is, there was somewhat of a race to get to that scale of sophistication. The bigger you became, the more scalable processes you could, the more sophisticated processes you could have at scale. and the more efficient you become. So it was somewhat of a race to the top. We never got pressure from our investors, because we bootstrapped the business the first 4.5 years to 5 years. Our Series Seed was more like an A round, and our A was more like a C round. So we were able to really just stay focused and maintain control of the company and say, look, we're gonna buy what makes fundamental sense to us in isolation. But I know that was not the case for others. Others were starting from scratch. They needed to get to scale. They needed to deploy to be relevant. Now, the good thing now is that there's also not a competitor being spun up every day. Before, it was almost every week you would hear somebody would raise the hand and raise 100 million. Now we can, be a bit more heads down and focus on what matters, and take the focus away from the headlines.
Yeah, there seems to be a bit more folks now on the sidelines. That's what it's starting to feel like, I think, which is, again, kind of a good thing. It just like with tech stocks. I mean, everyone's complaining right now that the Dow and the NASDAQ are all, going down and correcting. And it's like, dude, you've been sitting in an overheated market for 6 years. Of course it's going to correct. Feeling a little bit of that same type of sentiment, I think, with this. You got guys who just got overheated. They're sitting on the sidelines right now trying to restructure and figure things out. Would you guys add anything else to what Santi said about deploying capital?
Like the example that I've used a few times, when Zillow started buying homes and they bought 10,000 homes, and then all of a sudden they said, well, we've got to, get rid of these homes because we can't get the people to fix them and so forth. That example has always really resonated with me, because I think Zillow never, maybe they did, but really the business they were in was not buying homes. The business they were in was fixing homes. And if you didn't set up an infrastructure to fix homes, what did you do once you bought them? And so what business if you call them aggregators or whatever, but what business are we really in, right? And so if you set up a really sophisticated M&A team, but you don't have merchandising operations or whatever it does to get your listings back on, you're now realizing that we're not in the business of aggregating, we're in the business of selling stuff on Amazon.
Yes.
And so that has just, I think, hit, it's just hitting home now, right? You've got to build the ability to sell stuff on Amazon or whatever marketplace you're on, not the ability to aggregate. So it happens in scale. It happened to Zillow. It happens to a lot of people. And so, the ability to do that is just what everybody's feeling now, I guess.
It's like the good book I read a long time ago called The Goal, about bottlenecks in your supply chain, your production lines. It's like any manufacturer. It's like anything when you're building out infrastructure for an aggregator. You can't just focus in on what's coming in. Otherwise, you'll bottleneck what's trying to be produced and where you're trying to grow. I mean, it's a very simplistic way to say it, but it's very similar. I wrote down,
and it's just hard. It's hard, right?
I wrote that down, by the way. That's a really very good.
It's just hard. Look, I mean, we've been doing this for 13 years and it's freaking hard. I just got to say, and I don't know if anybody else doesn't feel it, but I think it's hard. It's really, really hard to do. And so I don't know if anybody listening to this thinks, so well, when you get to a certain size, it gets easy. I'm like, man, I don't think so. It might've been a lot easier like 13 years ago, but it's hard. It is just hard.
Operating a good business will always be hard. I mean, I remember, I used to work for a company called Evenflow, and they were, it was in the baby product space, about a $500 million company. And we would sit in, lead team meetings and talk about just how, I was sitting in with very, very smart CPG guys, a CEO who turned around Ben and Jerry's and he turned around, Smith and Wesson and Atari and Dove, and we're all looking at each other going, what are we going to do about the fact that, our competitor in Walmart just added this new feature and blah, blah, blah. It's just hard, man. And I think, that's what it's a great point to make, because I think a lot of sellers go into this trying to sell whatever they're selling on Amazon, thinking that these external factors, this engine called Amazon, is just going to do a lot of the heavy lifting and work for me. And now we're actually entering into an era where, again, everyone wins in the bull market, but we're entering into an era where it's like, no, you've got to really put your head down and kind of figure this thing out. No different for aggregators, and great point, I think, to call out. I think everyone, this is a webinar of positivity, but it's good to call out the fact that, hey, like, take stock for a moment. It's okay. If you're feeling how arduous it is, it's okay.
But I will say though, look, I mean, that is actually a funny thing, because it's funny to me, because when I got called from somebody who said, well, what do you feel about that 5%? Again, we've gone through a lot of these. There's a lot of times when Amazon has raised fees. There's a lot of things that make it hard. And it's interesting in hindsight, maybe I'm one of the older ones in the group here, but in hindsight, every time it gets hard, it does weed out a lot of the stuff that, you know, the sellers or whatever the competition that maybe is not up for the hard. And so hard has always led to a better place for us. It wasn't easy. That's all I'm trying to say. It wasn't easy, but hard sometimes. Yeah, I had a friend of mine who's in real estate, and he's like, I want to get out of this real estate thing. I think selling on Amazon would be easier. And I was like, man, I want to get into real estate. It's, you know, your business is just hard. And so I thought that was worth sharing.
That's awesome. So we'll look for the sake of time, I'm going to probably blaze through some of these last questions and maybe just call on one of you guys. So that way we can get to Q&A. We've got a lot of folks that are fairly active in the chat, which is good. They've got a lot of really good questions, like actually hard questions as I've been reading through them. But one of the questions that was in the chat, so it's germane to ask this now. You know, we walked through changes in the market, the view is shifting in how companies are valued, and criteria continues to get more specialized and, for a lack of a better term, you know, tighter, right? So how are you guys now assessing companies as they come across your M&A desk? You know, we talked about this a little bit earlier, right? You know, has your strategy shifted? But let's talk tactics for a moment. You know, are you guys looking at new categories, different categories? Are you simplifying and amplifying the categories you know you're really good at? You know, what's your thought process around that? Rowan, I'll start with you.
Absolutely, no, it's a very good point. I think, look, the way we worked is we set up an initially, and probably to answer the question before as well, is like, you know, invest heavily in the operations and the process and the platform. We proved that the business model worked in terms of you could buy businesses in a very short space of time and then go from there. I think phase 2 and where we're on now is very much honing into. We spent months and months recently investigating key categories and focuses for the future. And for us, it's all about categories with long-term growth and things like, you know, baby, pets, etc., that really have long-term true potential. But in terms of sellers specifically, I think, look, if you've weathered the storm over the last couple of years of, you know, crazy hyper growth potentially and supply chain nightmares at the same time, then that's great. If you've got that affinity with your customers, if you've got specific, maybe some product specialization or something that is differentiated from what is often a very, very busy market, then that's the most important part. But at the end of the day, the bottom line here is operational performance and underlying long-term potential.
And Santi, what would you say to a seller to position their business to be, you know, lucrative, attractive for operators, for the aggregators?
Run it like you would running it for yourself. Yeah. I don't know why there's this aura of advice of like, become a DTC brand or become like, no, do what makes the most sense for your pocket. Try to optimize for a cash flow today or a cash flow tomorrow, whatever you would do for yourself. And then try to communicate that as clearly to us as possible. We value the future. We value what you have in development, what you have in process, and just run it for yourself. That's the best way to become an attractive. Nothing has changed fundamentally. All there's changed is we went from a space that was hidden to the financial industry to seen perhaps too much by the financial industry, and now we're seen negatively by the financial industry, but at least we're on the radar, and we hope to normalize that, and at one point we'll just be seen as a category. And I always thank the first aggregators like Goja and Thrasio who kind of shed light on us, but just run it the same way you've always run it and try to communicate it as clearly as possible. We understand that Amazon had its first flat quarter and new competitors came in, so it's normal that your sales might be down in the last few months. What we try to bring is certainty. Like we closed deals that we signed even before Q1 numbers came in. So just run it for yourself.
Great answer. And you know, in my history of working in different CPG companies, almost everywhere I went, you know, being in the baby product space, there was a lot of innovation that we had to constantly think through because of, you know, new safety regulations, or, you know, the next competitor came out with the best new feature or whatever. So we're constantly thinking through product development, and really the theme everywhere I went was product is king. So Walter, how much does Goja value product development when you're assessing a brand, when you're assessing a company?
It's everything. You know, when we started Magic Fiber 13 years ago, it was an idea. It was a product. We were selling other people's products, and we said, well, we can make them better, because we would go back to the people selling us their product and say, well, your customers are saying this, and it would take them a year to do better or to implement these changes that we were suggesting. And that's how we started developing our own product. So before we were doing almost anything else, it was about product development for us. And it might be as subtle as, taking an inch off a box, that's product development, to launching a new product that wasn't in the space that we thought. So product development to us has always been at the core of who we are. Literally, it's we don't buy a brand that we don't think we can product develop ourselves into growth, not PPC into growth. It's all about product development. And so we normally look for brands where we see a lot of product development or innovation around product capacity potential. Not just is it a really good seller and can we keep it selling there? It is, can we pump new product into this brand? So product development is everything. We've had a really deep product development team and strategy for a long time.
That's great. Rowan, what are your, so kind of moving a little bit into, we'll get through this, I think, fairly quickly, and then we'll go right into Q&A with our last, call it, 15, 20 minutes. If I'm not sure if we can go over the hour just a little bit, but I definitely want to get to some of these good questions. But, from Hero's perspective, what's your macroeconomic views for the next, call it 18 months? And how is that going to affect your operating strategy moving forward?
Yeah, I mean, if we think about general global, the total thing, if you ask the same question 18 months or 2 years ago, there's no way in hell you'd be able to predict what just happened. Same thing, like going forward, who knows what's going to happen? I think there's a lot of uncertainty around the corner. And that's also, at the end of the day, business models like ours existed to de-risk from a seller's perspective. It's a lot of people I speak to are often saying, oh, I might sell in 6 months or a year's time. Actually, you never know what's around the corner. But in terms of what we're thinking about from our side, I think the market and certainly our whole sector, I think will be, no doubt you'll hear some more negative news. There's gonna be people who really struggled and have bought stuff, or brands that have really struggled over time, and they may have to put up a white flag. I think it's going to be harder to raise capital. I think a lot of the time we get affected by what happens in the public sector. That will then have a knock-on effect in terms of the private sector as well. So all of that will have knock-on effects. But most importantly, I think that the theme throughout this entire call is all about operations, and that's where all of us, whether you start off as an operator or whether you've become an operator, I think it's increasingly focusing on the teams, the structures, the platforms in place to keep growing these brands and taking them all over the world.
Great feedback. And I say for our final question here, and then we'll run into the Q&A. Santi, what do you think about the future, Mr. Computer Science? What do you think about the future of commerce? And fast forward to 2025, how are consumers shopping for brands in the next several years?
Look, the fundamentals have not changed. It's the convenience that Amazon brings. Is equivalent to the convenience that Netflix brought to Blockbuster. Things, we don't have any doubts on the future of e-commerce. It's still one of the fastest growing. I say we're in a double rising tide. Amazon is growing over e-commerce. Most people don't know this. But then obviously people know that e-commerce is definitely taking over retail. So we're happy to be in this industry. The future is bright. Although it's never been easy, so it's nothing's changed for us. I don't know how to predict it in the next 18 months. Our model, like Ron said, it's there to de-risk and to give capital to those who create and add value. But we're still investing in the future. We have 200 products in the pipeline for product development. We think there's still room to create new products and launch new products on Amazon. We still think the pie is going to get a lot bigger. We launched both our own brands. We have 7 brands in development, as well as products within the brands that we have acquired, which is the best signal that I can give to you that we are very bullish in the future, and we look forward to having peers in the industry that are good operators and taking all the noise away. So very, very, very optimistic.
I like it. Well, great. Thank you guys for kind of walking through several different questions. We really kind of went through the yellow brick road of where we are today and where things are headed. Santi, thank you so much for that feedback as well. Well, let's dive into questions. So I think the best way to handle this is I'll throw out the question from the folks in the audience, and anybody who just feels like they're the best person to answer, just answer, and then we'll move on to the next question. I think just to try and get through some of these things. Which industries and niches will be affected more or less during this correction, and with all of the macroeconomic headwinds that we have felt? Obviously, there tends to be certain sectors that win and certain sectors that lose. Through the pandemic, we saw hand sanitizer and masks won, and they are no longer, there's still a market for them, but they're not winning anymore. So very simplistic example, but which industries and niches do you guys think will be affected more or less during this correction? Anybody who wants to take a stab?
Yeah, like certainly from our side, I think when we're looking at certain sectors, we've done that kind of category focus and torn apart so many different areas. I think at the end of the day, look, we're looking for businesses and brands that are here to stay long term. And I think you saw some insane, crazy growth in some products. You mentioned hand sanitizers. We saw a lot of like sports and home gym stuff exploding in the last kind of 2 years, right? You know, will those things see the same potential in 5 years, 4 years, or will people prefer going for a run or going to a gym outside? I don't know. But at the end of the day, I think things that will do well, I think are non-discretionary items. They're products that people invest heavily in for, you know, we love baby, pets, and a few other segments. They're things that people are, you know, they have underlying really strong macroeconomic kind of drivers beneath them. I think that's something to just bear in mind.
Next question. What are some of the things that an Amazon brand business does that help them stand out from other businesses looking for exit and increase their potential valuation? For example, external traffic, their own website, customer base outside of Amazon. We addressed a little bit of this, but does anybody want to quickly take a stab to say, I mean, look, this is a loaded question. We could be here for another hour webinar just about this, but does anybody want to take a quick stab at maybe a few sound bites on what are some of the things they can do to really help them stand out?
I'm happy to take a step. Look, do more of what works. I think the worst advice people get, and I don't know who came up with this, or it was probably an investment banker somewhere, is like this diversification. This diversification concept I've never been a fan of. Think about, look at your last year, look at your last 2 years. How did you get there? What were the actions you took to get there? And then just do that 3-4 more times. And then just explain your reasoning. It's like doing a math exam. Hey, I got to this answer and this is why. Because that way we as the future owners of that brand could then continue that and take the baton and continue forward. So just act as if you're going to own the brand for the next 5 to 10 years. What would you do to make money for yourself? Nobody's looking, nobody cares. It's just you and your bank account and your Amazon account. What would you do? Do that and explain your reasoning. That's it.
Awesome. Great answer. And I'll push off your investment banker comment, and I will deflect and say it's private equity that started that, man. They always want diversification, but forget those guys. We're talking to them.
Should have said P. Should have said.
That's right. Any advice on entering other international markets outside of the US? You know, how would you manage your PPC in the other regions? Would you outsource, keep internal? You know, just all things international. You know, what in your view is the best international emerging markets? If Amazon approaches you about these markets, does that mean they see big potential or just them selling their services? Like, what are your thoughts? Walter, why don't you take a stab since you haven't yet on international?
They, excuse me. I think they're marketing and they're trying to grow their presence. I used to get really flattered when I used to get those emails, and now I think I'm one of quite a few. So I do think it just has to be around your bandwidth and your capacity to operate. I think that feeling of expand, and then you got to figure out how to speak German to create a listing or compete on PPC is just not, you know, it's I don't think it works that way. So I mean, we're pretty focused on the US because that's where we think our core competencies are. I think that'll change at some point, that'll evolve. But for us, we really think there's a huge market in the US and we can continue to win in the US. But that's just how we've handled it.
Yeah, that's
in the Americas, I mean.
Great feedback. Another question that I think is fairly interesting. What are your thoughts on newcomers, new operators, new aggregators coming in now to this space? I mean, you know, to your point, I don't know if Walter, you said it, or Santi or Rowan, but you'd wake up every day and, you know, a new aggregator, I think it was you, Santi, you know, raised another 100 million and here's another aggregator on the scene. And, you know, you didn't really have much of a mandate. It was just the same conversation. We're buying Amazon businesses, but, you know, now in 2022 going into 23, you know, what are your thoughts? Is there room for newcomers, and what are your thoughts on that? Anybody can take a stab.
I'll take a quick stab at that. Just in preparation for this, I took a quick Google search and I found just in the past few months, I think it was 9 announcements of, you know, aggregators raising hundreds of millions of dollars still. You know, many of those are in Latin America. Asia's obviously growing too. I think what what they're starting to do is to, take the lessons of this first wave that we've all kind of ridden and use that for international growth. It's nice to watch somebody, see a few people succeed, a few people consolidate, and what we might call failure, but it all teaches that lesson and it kind of trickles down the system. So it's not over, that's for sure.
Yeah, that's right. And I think there's a lot of these questions, man, there's so much more to say, but instead of being a word we used before we got on the webinar, loquacious about this, we'll just move on and try and be succinct. One of the questions, thoughts on the recent news from Thrasio, did they grow too big too fast? I'll take a stab at that. Yes, I think they did. I think this happens a lot when you're trying to really be call it first mover advantage. Unfortunately, you can run into the inverse or averse of what you want to happen with the way that you're building out your operations. But I would say, just to answer it very, very high level, I think the consensus would be yes, they probably did do a little bit of a too big, too fast, and didn't really take the time to go, okay, let's be a bit more methodical, but we'll move on. This is not about them. This is about you guys. Let's see. Kind of already answered that about some things that an Amazon brand business can do. One for Eric, man. When does the pain of product development end and the capital inflows and bullishness begin?
Pain of product development. I think to echo Walter's sentiment, it never ends. And hopefully it's not painful. I mean, if you've got something you love and you're selling it and you put your blood, sweat, and tears into it, hopefully that product development is a continuation of that passion. But I would say that never ends. If you're hoping for that to end, you're probably in the wrong business, because if you want to keep selling, you got to keep innovating.
It's interesting because to me, it's the most fun part. It's literally the most fun part. Like, having a product in your head with the team, and then all of a sudden somebody buys it. You're like, wow, it really worked. And then they buy it a lot of times. You're like, man, that really worked. And I think it's the most fun part, frankly, of this whole crazy industry that we're in. I think it's the most fun part, for me at least.
Yeah, I would say if you're not bullish on that part of it, that's what should get your blood going, right?
Yeah.
That first sale of a new product. It's pretty cool.
Totally agree with that. From a good friend of mine, and maybe y'all's as well, Mr. Lippy from Escala asked the question: if you could tell your January 2020 self one piece of advice, what would it be?
January 2020?
Yeah, pre-pandemic. What would it be? He's always bringing these questions that make you just go,
We would have bought less inventory.
Okay.
The inventory came back a little faster than I thought it would.
Interesting. Anybody else want to take a stab at advice on 2020, January 2020 sell?
I'd say believe in your thesis. Just stick to your guns. Don't think that because others are doing well doesn't mean your thesis is not doing well. And maintain the long horizon.
Yeah, that's great. Someone asked a question about, first off, the future of the aggregator market. That's a fairly generalized comment, so I'll try and make it a little bit more detailed. I mean, do you believe on this panel we're going to continue to see more consolidation? I don't want to use the term failure, because I don't think there's going to be lots of failure. I heard from one aggregator once that there was going to be 7 of aggregators left at the middle of 2022, and like Nostradamus, that prediction is wrong, very, very wrong. Thoughts on that? Where do you see the operation, the aggregators, the operators in the coming, call it 18 months? Rowan, take a stab at that, man.
Yeah, absolutely. I mean, look, I think the similar analogy we can look back to a couple of years ago was something like the food delivery market, right? So actually, same sort of idea. All these companies and all these markets started up, all these different people started up claiming they had different ideas or different concepts. And in reality, over time, there were consolidation inside some of these entities, but also, there was different cross-market opportunities. There's so many different opportunities on the horizon here. I think it's a really exciting time, both for sellers, but also for this market in general. I think in total, I saw an article the other day saying it's like 100 aggregators and 15 billion or something crazy injected into the space. over time, we're starting to see that kind of simmer down a little bit. But I think there will be in the future, there's going to be some consolidation, but also some interesting, more strategic deals, maybe some, swapping big brands across. Maybe I buy your pet brands and you take some of my, I don't know, outdoor brands maybe, or something. There's some really interesting deals to be done, I think.
Yeah, I think it's great. Well, look, we're up on the top of the hour. I really appreciate everybody's time. I think in just a few closing notes for this particular webinar, to do a little bit of a recap of what we discussed. Current market changes are giving aggregators the ability to pivot, recalibrate their strategy. Restructuring is a natural evolution of any healthy company as they adapt for their version 2.0 or 5.0. But operators, true operators like the panelists that we have on today, will continue to adapt to current market conditions and drive the strategy that permeates into the next wave of commerce or e-commerce. I think aggregators, operators are more diligent, as we've heard today, in the brands that they're buying. They're focusing on quality, not quantity. This in turn will cause brand owners to also recalibrate their own strategy and tactics. It will force brands to become smarter about how they drive alpha for their business. That's a little investment banker term. Showing proof of steady growth, product development, innovation will make your business very attractive for these operators. Essentially, creating a valuable asset means you now need to rotate towards traditional CPG's tenants. And finally, I'd say choosing the right operator is just as important as picking the right product to sell, and do it wisely. Remember, you are interviewing your potential acquirer just as much as they are interviewing you. But the good news is you've heard from some of the best today. So gentlemen, I appreciate your time. Thank you for coming on, and we'll talk to you soon. Thank you for everybody for joining us today.
Thank you very much.
Thank you all. It's been fun.
Thank you.